Hey everyone, thanks for tuning in. I'm Andrew Cox, research analyst here at FreightWaves. I'm here for Great Quarter Guys episode 45. I have been giving you a bit of a number from a sports player of that day. I'm going to do the reversal today. I'm going to shout out number 54, Max Fried, who started for my Braves last night. He pitched a beautiful 5 2/3 innings. Braves got the dub against the Dodgers. So I had a great day. I'm in a great mood. Kevin, how you doing?
You are. You definitely are. And our last episode was last Thursday during the conference,
That's
so
right.
we didn't really do a number, but it was 44, another great Brave.
Hank Aaron.
Hank Aaron. Hammer and Hank.
Henry.
44. So we got to catch up on that.
Yeah, we'll get back on the number system sometime next week. We'll talk about what we're going to do next week at the end here. But let's hop in. We got a fun show. We're going to talk a little bit about Dillard's. We heard news that Ted Weschler, who is a money manager, kind of a protege of Warren Buffett, he had bought $45 million worth of Dillard stock in his own personal account, which to me seems outlandish. But we're going to talk about whether there's read-throughs to the overall market or not. Then we're going to talk some more SPACs because, you know, there's always something to talk about the SPACs. There's 8 more clean energy SPACs that are supposed to close before the end of the year. Then we will get into how there's another space company that's going to do a SPAC. This one, Momentous. I'm actually going to try to get somebody from Momentous to come on SpaceWaves back at the end of December when we have our conference. It's going to be focused solely on the logistics of space. Momentous is a last mile delivery company in space, so really cool. We'll talk about that when we get there.
Is there a middle mile or a first mile?
I guess SpaceX would probably be first mile, but yeah, they're actually partnering with SpaceX. But we'll get into all that after we do our ode to highly questionable see or no. This is called You Care or Nah. How this goes again, I will give you an idea, I'll show you something, I will give you an event, and you'll tell me whether you care or nah and why. The first one, let's show the tweet. I saw this tweet last night. I got super excited. This is from Hindenburg, the short seller. I saw this tweet and thought maybe it's another transportation company. Maybe it's Workhorse. There was a lot of people that were kind of speculating on that because that stock has done so well over the past few months. It turns out it is just it is Loop Industries, who I actually don't know much about, so I can't get too excited about it. I did care a lot yesterday because I was hoping it would be somebody we know. Loop Industries is a plastics recycling company who has no proprietary technology, is pre-revenue, and has partnerships with massive companies like Coca-Cola and Pepsi and Walmart. Does that ring a bell? Does that sound familiar to you, Kevin?
It does. It sounds like the last report that they did with a company that had no revenues and a lot of partnerships with big names and a lot of promises, but no proprietary technology.
Yeah.
I think
I think that was Nikola.
I think it was. I think it was. And you know, I don't understand the wealth in plastic recycling. Because I know I was a freight broker at one point. I handled some of those goods, right? The raw plastic coming back in and the plastic coming out. And plastic's very light, and transportation costs moves very cheap because it's a large part of that. But I know the margins aren't really all that great for legacy technologies, so I don't know how much you're really going to approve why it's such a darling, but it is pre-revenue, no technology, a lot of partnerships that go nowhere. So
I think that's the biggest thing, right? It's ripe for innovation. We haven't seen any companies really go out and do anything different in recycling. We haven't seen any, we see all these story stocks with these SPACs and with IPOs or even, just story stocks in general. And this one is another story stock. It's something that's somebody that partnered with Pepsi and Coca-Cola, and people say, oh, this company is revolutionizing the way that plastic is recycled. But it turns out they did a bunch of interviews with ex-employees and people that had worked at the company before, and it turns out they really don't have much tech at all.
And then that's something you find out sometimes, and they don't really have any cool graphics to show, right? They can't draw a badge, right? Or a cool truck or a vehicle, or say we're going to change the world in the energy realm, which is a great story. We're going to recycle plastic bottles better. Doesn't really, I wouldn't buy a movie ticket for that.
No, you wouldn't. Let's move on to something that I would buy a ticket to. This is a Red Ball Acquisition Corp. This is Billy Beane's company. We talked about this a couple weeks ago. Billy Beane is, of course, the mastermind that kind of brought analytics and data into American sports, the guy behind Moneyball. So he created a SPAC called Red Ball Acquisition Corp, where he is the kind of co-chair here, and they are now in talks to take Fenway Sports Group, who is headed by John Henry, which you'll get into a little bit about their relationship. The talks is to take Fenway Sports Group public. That company owns both the Boston Red Sox and the Liverpool Football Club. Kevin, you care or no?
I do. I do care just because I'm a huge Moneyball fan, huge baseball fan, huge Moneyball. Billy Beane, it seems like what he does gets my attention, and well as it should. You know, he's really changed not only baseball but all of sports and business as well. You know, going after he's a value investor, and then that's what Moneyball is. It's value investing. We'll get to it with Dillard's here a little bit later in the show about value investing. But that's, you know, you take what's undervalued in the market and you try to build something around that, and that's exactly what he did. And so I really do care.
Yeah, I do care as well. I love Billy Beane, but I also love John Henry. He is the owner of the Red Sox, owner of Liverpool Football Club. He bought that Liverpool team in 2010, and it was a mess. He ended up getting it in. It was through a very difficult court battle, but they ended up winning the Premier League last year. So, you know, he's turned that program around. And Billy Beane, he's gotten into soccer big time recently too. He's gotten minority stakes in a Dutch football club and as well as a second-tier Premier League team. So he wants to get into soccer. John Henry has been courting this guy for 20 years. He once offered him $12.5 million to be the GM of the Red Sox after the Moneyball days. He turned that down. But it seems that Billy Beane, if this deal ends up going through, that Billy Beane's going to step away from baseball, because if he owned even a minority stake in the Red Sox, it would be a conflicting interest, and the MLB would not let him own two teams at once. So, because he does own a minority stake in the Athletics as well, so it looks like he's going to step away from baseball and really try to go after something even bigger and make this sports conglomerate own football clubs and baseball teams and arenas. All of that, I'm super excited for.
I am too. I'm super excited about it too. It'll be an interesting story, and of course, it's a SPAC.
Yeah.
Of course, it has to be a SPAC. If it's 2020, it has to be a SPAC. If someone's going to buy anything, it seems, or go public. So it's going to be very interesting. I'll keep a lot of tabs on the progress of that, and hopefully, for our sake, I suppose, I hope it goes through.
Yeah, it'll give us something to talk about. I'll definitely be keeping up with it. Let's move on to next one. This is our first talk of space today. We'll get into momentous here in a little bit, but this one is on SpaceX. It has been announced that SpaceX has got a deal going with the Department of Defense. This is, you know, we talked last week about Boom Technologies and the supersonic jets that's going to speed up travel of humans. This is something that Elon has talked about for a long time, that they want to use the Starship, the ship that will eventually take us to the moon and to Mars. They want to use it for Earth-to-Earth travel. It seems this is the first time they're going to do that. They're not going to be traveling with humans this time. They have done a deal with the Department of Defense to carry guns and ammos and things from here to Afghanistan. That's about a 7,500 mile trip. He says they can do it in an hour. You care or no?
I don't really care too much about it until there's more progress with it. I mean, why couldn't you put it on a missile? Well, I guess it would land,
this
right?
is technically a missile. It just happened. This missile lands upright.
So I think it'd be cool if they can actually do it. If they can't, then they can't, but I can't get really too excited about it.
Yeah, I mean, it's going to be a while. They think that they'll start testing sometime at the end of 2021. They're still doing Starship hops, as they call them. We showed one on the show a few weeks ago. Those are only getting bigger and better. I think the next one's going to go up to a couple miles and float there for a little bit. So we got a lot of milestones to hit before we do that. But the idea of taking the equivalent of a C-17 payload and going anywhere in the world in less than an hour, it's pretty exciting.
It is cool.
It's exciting.
It is cool. I like what is it, Sky Boom that we talked about last week?
Boom Technologies.
Boom Technologies. Yeah. I like that better. It's more Concorde. It's technology that has been around for years. I mean, for 50, 60 years, and taking where the Concorde left off and doing some really cool 3-hour trips from New York to London.
Yeah, I mean, it probably won't make sense for me to get on one of those anytime soon, because I'm not, I think it makes sense for the business travelers that go once a week and they have to cut down their time. For me, I don't mind getting on a plane for 8 hours. I actually kind of enjoy it. I love watching movies, and I sleep like a train anyway.
Really?
But yeah, let's move on to something I watch while I'm on the movies, and that's the movie theater. While I'm on the jet, and that is the movie theaters. I just read today that movie theater chain AMC Entertainment, the largest in the country, says that it will run out of cash before the end of the year if they aren't able to raise additional funds or are able to bring moviegoers back before the end of the year. Kevin, you care or not?
I do care. I like going to movies. Some of my favorite memories are going to the movies. I like to go to movies now. I haven't been in a long time because of the outbreak and everything. I will say I don't care if they go bankrupt or not. I mean, a movie theater is a movie theater. The real estate's still there. The infrastructure's still there. They're going to restructure debt, which would be a very good thing. Better thing is restructuring how movies are distributed from Hollywood into the theaters and then on to or I guess online now, not even DVDs. No. You know, did you ever go and rent a VHS?
Of course, yeah,
cassette tape?
Of course. I remember going to Blockbuster. I remember the birth of Redbox as well, when those Red Boxes started showing up at Walgreens and then at McDonald's. So I remember those days, definitely.
Yeah, so all of that needs to be restructured, kind of like the movie or the music industry has done over the last 20 years, it seems. Yeah. I don't know if they ever get it right. I don't know if the Hollywood will ever get it right, but it needs to be restructured. So I do care about it. How about you?
Yeah, I think I do care. I want to say that I agree with you that they need to restructure the way that movies are distributed. That's part of the reason that we heard the rumors of Amazon thinking about buying AMC a couple months ago, finding some sort of synergy there where they could put out their movies, at the theaters. But yeah, they have a major issue in that it's expensive to go to the movies, and then all of the accessories are expensive once you get there, buying your popcorn and your drinks and everything else. It's expensive for a consumer to go. That's why, I mean, we talk about the $30 direct-to-consumer movies that they're releasing on Disney Plus, and Dooner and his family they think that that's a good deal. You know, for me, $30 is crazy. I couldn't imagine paying it to sit there and watch a movie. But if you got 4 kids and you can buy the popcorn at the store, then you can really make that a good deal. And I want to disagree with someone here, Craig. If you're watching, you said that this was the acceleration of something that should already die, and it's time for movies to die. I disagree with that, because if that were the case, I don't think that the drive-in theaters would have really popped up again as they have over the summer. People have been very excited to go back to the drive-ins. That was a dying art form over the last few years, but those are coming back because people like going to the movies. I think they like the communal aspect of a big screen and good sound. So yeah, whether they go bankrupt or not, I don't really care, but I really hope that this isn't the end of movie theaters.
I do. I don't think it will. I think everyone likes, or not everyone, but there's enough of us that like that experience so that it will go on. Distribution needs to change. I think if you're a production company right now in Hollywood and you're wrapping a film, why do you have to go through the normal distribution channel? You can go straight to home through Amazon or Netflix or whatever else, and be as successful as going through the movie theaters right now. So once that changes, though, I think it's creative destruction. Yeah. I mean, that's what we're looking at. Yep. We're looking at creative destruction, innovation, disruption. It's all about, it all goes back into creative destruction. So the movie business will change, distribution will change, and that'll be a good thing for consumers and the two of us who like to go see the movies. I
can't wait to go back to the movies. We have the $5 refill bucket, and I went just to the movies to try to fill it up. We bought it back in January, and the movies weren't even open. It was like last Thursday at 5 p.m. I thought the movie theater was going to be open. I guess our movie theater is one of the 140 that they haven't reopened yet here downtown in Chattanooga. So that's a shame. AMC, I want it back open.
Well, now I want popcorn.
Yeah, they got great popcorn. All right, let's jump to Dillard's because their stock jumped 30% in a day yesterday. It's pretty easy to find out why. It was kind of two news stories that came out. The first one is, like I said earlier, that Ted Weschler, the investment manager, the money manager is his title, I think, at Berkshire Hathaway. He had scooped up nearly a 6% interest in the company that makes him the 5th largest shareholder. This is, again, in his personal account. This is not Berkshire Hathaway investing. But the stock soared there, and they also got an upgrade from sell to neutral rating from somewhere, from Wedbush, actually. And the reason why he wants to buy this, he thinks that they've been very disciplined in their pricing and in their discounting over the past few months. They have been more reliant on brick and mortar. They actually have a very small online presence, which, of course, we see as a very weak point because COVID-19 has made everybody buy more stuff online. But he sees it as kind of a benefit to them because they have less fulfillment costs. They don't have to work so much with reverse logistics as as Mike was saying earlier, it's like 4 times as many goods get returned if they're bought online as if they're bought in store. So those type of things, they get excited. You have another angle at it, which is the real estate value. So let's just talk. Are there read-throughs to the retail economy here, or do you think this is kind of a one-off value play in which Weschler saw value in this company?
I think it's a one-off play. I think it's all about Dillard's owning their own real estate, and I think, and I don't know where it is exactly here, but I think 250 out of 280 stores, some outrageous number, Dillard's owns, and it's really assessing the value of that right now. They're trading below book, what's reported. So your property, your property assets are reported on book, but that's not the fair market value of those. Mm-hmm. So. What I do know about value investors, and I've worked for a research firm that some of the famous value investors go to do deep dives into different sentiment, talking to ex-executives, things like that. What they do is they go out and build their own portfolio of real estate assets. They get a very good bearing on what that number is, and based on that, they have a value of the stock. And is trading under book value, probably trading under fair market value of that real estate right now. And I think it's just a deep value play.
Yeah, I agree. I was talking to Seth about this. Oh, by the way, we wish you well, Seth. We miss you. He's on vacay right now. I think he'll be back with us next week. But I was speaking to him about this, if he thought there were any read-throughs to the market, because he's my go-to for consumer and retail things. And he said he really couldn't think of any. He just thought this was a beat-up stock, a beat-up company that, again, looking at some sort of fair market value on the real estate. We just read from somewhere that their dollar per square foot value is something like 27, and where you can buy Simon Property Group or some of the other mall people in upwards of 40. So you can see that there's some arbitrage availability for him there. But I just don't see much of a read through, because this company is I thought was kind of a dying company. I think another thing to read through here is the dichotomy of the economy right now. You have the have-nots and the haves are getting wider. Unfortunately, the people with the least income have the ones that have been losing their jobs during this pandemic, and they're the ones not benefiting from this. And so Dillard's is a kind of a higher end thing. So there might be a play there that they're doing okay because they sell a little bit higher end stuff, whereas some of the players that sell to the lower income families are not doing as well. Yeah,
and they're kind of middle of the road. So they're higher for middle income. They're not luxury by any means, right, but they have that. There's premium brands in the store. One of the downsides to this is the management team. So Dillard's, they don't have an online presence. They're certainly not trailblazers in innovation, right? and it's family owned, which is sometimes good, sometimes really bad. The 3 brothers or the 3 sons of the founder of Dillard's have a controlling, and other directors in the family have a controlling voting share in that stock. So you're kind of handcuffed to what they're going to do in the future. So that might not be a huge e-commerce platform. It might not be a lot of innovation. You might sit there and just wait on the real estate to appreciate.
It's like that. This is a classic, even though it's not Berkshire themselves, this is just a classic Berkshire move, right? We were talking earlier how if you look at Berkshire's holdings, it's gotten, because of the growth of Apple, it's become un-Berkshire-like. They've got about 1/3 cash, 1/3 Apple, 1/3 everything else. And that's just not something you expect from Berkshire. But this type of move, deep value play on a company that I wouldn't touch with a 10-foot pole, that's right down Berkshire Hathaway alley.
It is, and it's one of those investments that only someone could do in their personal account, right? Because there's so much cash that if Berkshire invested $50 million in something, it wouldn't mean it's a rounding error.
No, it wouldn't do anything. They got like $180 billion in cash right now, or something, $120 billion, something ridiculous.
I know.
Okay. So let's get on to the SPAC. The bonanza continues. The news here is that at least 9 clean energy companies, most of which have little to absolutely no revenue, are planning to go public between now and the end of the year via special purpose acquisition companies or blank check companies, similar to what Hyliion is going through the process of doing right now, as did Nikola. So we've spoken about SPACs ad nauseum here, but they just keep making news. Last one was Hyliion, who is as a crowd favorite here at FreightWaves. They make electric propulsion systems. I'm going to give you a little bit of info on the other. I've got 7 of the 8 here. There are 2 companies that make sensors for autonomous vehicles. and then there are 4 electric vehicle companies, and then 1 large-scale battery company. Of these companies, only 1 has meaningful commercial revenue, and that is Velodyne. They had about 100 million over the last 12 months that ended June 2020. 5 of them had no revenue at all, and Hyliion had just 1 million or so this year. Hyliion does expect that number to grow to 2 billion in 2024. Here's the kicker. The average clean energy SPAC has an anticipated enterprise value of $1.8 billion. Kevin, what do you think, man? Are these companies disclosing enough information, or investors getting taken advantage of? What do you make of the market for these SPACs right now?
I don't know if it's either one of those. It looks frothy.
For the companies.
I mean, it's very frothy. And this is where, when everyone's rushing into a financial asset, this is what you find. And I don't know enough about really any of these companies. I know Hyliion a little bit. But once you get a mad rush of pre-revenue companies going public, bad things are going to happen at some point, right? I mean, it's inevitable. It is going to happen.
I mean, do you think there's a reckoning coming of some sort? Is it going to be this big event, or is it just going to be they kind of slowly taper away? Because the 2020 has been a major outlier. It's been like something like 2.5 times as many SPACs today. 133 so far this year compared to 60 last year. They've raised more than 3 times the money this year. Is this going to be a one-off year, and we just see it immediately taper off, or what?
No, they're going to go to the limit. They always do.
They always do,
Any financial innovation goes to the limit. It goes well past the limit, and there you go. I mean, it'll probably end up with maybe a WeWork type of moment, which I don't think Nikola was. I think Nikola was just in front of their skis.
I wanted to discuss that as well, because
but you're going to get, and I don't think WeWork either, right? I mean, WeWork wasn't a fraud. WeWork told you exactly what they weren't doing, but no one paid attention. Right, you know the holes in the business model.
Yes,
so they're very upfront about it. They tried to paint it as a positive, but it wasn't. But you are going to see at some point, I don't know when, but all these companies rushing in, you are going to find complete and utter frauds at some point. It just happens every cycle.
And I guess I framed that the wrong way, because the more I think about it, unless it is a complete fraud, then investors aren't getting taken advantage of. This is the beauty of the stock market, right? Is that investors can buy, especially now with Robinhood and free trading, you can just buy whatever you want.
You can. If I walked up and said, we're pre-revenue, but I think our market value is worth $1.8 billion, and you buy some of my stock, what have I...
You haven't done anything to me. No.
I'm telling you up front.
And that's the thing, I guess the thing that the SEC is looking into right now, they are discussing if the companies are disclosing enough about the investor pay scales, how the people that raise the money for the SPACs are actually making the money, and how much the founders of the company make from these SPACs. And I think that's interesting, because that's something we don't always know. We know, we've talked about this, like Chamath Palihapitiya, the guy from Social Capital who's going to do dozens of these SPACs. He writes the check, and he immediately, within a couple weeks, makes a couple $100 million.
And I think I read somewhere Thomas Healy, the CEO of Hyliion, is he's locked in for quite a while. So that's good. But I think there should be more disclosures about how everyone's going to exit and get paid off of it, because if you don't know by now, it's a good way to cash out.
Yeah.
It's better than IPOing if you're pre-revenue, right?
Yeah, I agree. And that's what I was going to get into in our next segment, which was just, we're going to keep the SPAC train rolling here, and that's that news on Momentus. And, the really question here is I think space may be the best use case, or one of the best use cases for SPACs. It's a company that is basically solely based on what kind of innovation and research and development it can have. It needs to raise a lot of money really quickly. Their pre-revenue, their stories, it makes more sense for a capital-intensive business than it does a technology stock for me.
I don't know if I agree with you, because it's a bigger bet. It's a bigger long shot. We are going to do the final mile for outer space.
Oh, yeah,
it's a great story.
I didn't even explain how that works, if anybody wants to care. So their business is called the Vigo Ride. So this is basically imagine a mini little, like a drone almost, a drone for space that attaches to satellites, and it travels up with the SpaceX rocket. It gets to a certain point, it breaks off with its 3 or 4 satellites, and it pushes these satellites into the orbit where it needs to go, and then this thing either returns back to the spaceship or returns back to Earth. But it basically uses a very basic engine and just pushes. It literally just pushes satellites into orbit, which is interesting. I have no idea what the market share or what the market value of that is, but it's going to make its first launch with SpaceX later this fall. It's scheduled to go on the Falcon 9 up, and it's going to help deliver, 60-something satellites.
So the first risk is that SpaceX actually works. Because if SpaceX doesn't work, or if they don't hit their benchmarks, then
correct. You're definitely relying on a
Momentous is out holding the bag, right? That's a very complicated thing. I mean, it's going to take years of development, maybe a decade of development. So shouldn't that be more in tune to the private markets? That's a very risky scenario. No, whether they do or not. I mean, I don't know. I don't know too much. Of course, I'm not a rocket scientist.
I was going to ask you why you didn't think of last mile in space when you started carrierless. Why you didn't think that was the best realm for you?
Well, it's you have to start small, right?
Right.
You start small and you work your way up. So last mile in space. I don't even know what that means. There's only there's just
there's only like 3 companies that even launch anything to space. 2 of them are owned by state governments in the Russian and Chinese owned governments, and space, and then there's SpaceX. That's pretty much it.
So
right now,
do people in the space station, do they need Doritos or don't they already have that?
They don't deliver anything but satellites. That's the only thing that their last mile is from rocket to orbit point. So that it would be easier for the rocket on its way to the moon, I assume, that the satellites can just pop off, and then this Vigo Ride can put them in the right orbit and then return back to Earth.
So the strange thing about all of that and the riskiness of it is that all of this actually has to happen. Even if you get everything right in your rocket science, everything else has to be there. All that infrastructure has to be there for it to happen. So that's the reason why I don't really think it's a great thing for public investors, right?
I guess that's why it's valued at $1.2 billion and they don't have any revenue.
$1.2 billion. So you're going to have an equity analyst asking you tough questions every quarter as you report your numbers about, what are you going to do the next 3 months?
Yeah, no doubt. I mean, it's gonna be tough. I only bring these things to talk about because I find them fun and interesting. I don't have all the answers. I'm no last mile space expert. I have no idea. But one thing I am trying to become an expert in is Walmart. That's what we have next. This is our last topic of the day. The news here is that analyst Oliver Chen from Cohen and Company, that he believes that Walmart is in the early stages of building their ad prowess. He believes that Walmart might soon be profiting from selling more than just goods. He also says that Walmart has a long-term opportunity to develop a leading advertising platform. So Walmart has recently brought its media group in-house. It has also been rolling out tools to provide better insights and analytics for advertisers. And I mean, I like the move. Margins are great on advertising. The guy from Cohen thinks that's they can get up to 30% or so margins on this. This is the e-commerce business that is growing 100% year over year in Q2, but the margins are not very good. They got compressing margins from reverse logistics and overall fulfillment costs, things that we've talked about. I think this is a great way to subsidize and juice the e-commerce margins. What do you think?
I love it. I do. I love it. We talk about it almost every week, it seems like, is that
Walmart is always making noise.
They are. They're always making noise. They're turning into a tech company. It's going to raise their multiple, even without... I like moves like that, because even if they don't increase their sales, they're just going to increase their multiple with all these moves. Partnering with Shopify, the final mile company or the delivery company in India. This move right here,
Flipkart, all the drone deals, all of the autonomous vehicle deals, all the electric vehicle deals. They're really spreading. They're like a VC right now. They're spreading a lot of bets out, and they are hoping for the best. And I think it's a good thing. They've worked with so many different companies in autonomous vehicles. I know they've got to deal with Too Simple, and they're now the leader. Getting some of these deals with the big companies is really important for these young freight tech companies to get their growth. So I love it. This one obviously isn't freight tech, but here's just some context here. He thinks that they can grow to $3.4 billion by 2023. That would be just over 5% of its e-commerce business. And for context, Amazon does about $14 billion in ad revenue, so they could get to the quarterly segment for Amazon by 2023 for an annualized thing. So it'll take some time. They're obviously not going to be Amazon tomorrow, but I love what they're doing.
I do too. I do too.
All right,
they're
I got some
becoming
shout
tech.
outs. Next week, Seth's back. We're going to talk earnings. We got a bunch of carriers and brokers giving earnings this week. And then also, everybody go to the FreightWaves TV app and download it. You can get all of our content there. If you want to get the podcast, you just want the audio, that's cool too. Head to wherever you get podcasts, Apple, Spotify, all of them. We're on there. Just search Great Quarter Guys, or even better, you can look up Freightcasts and you can get all of the FreightWaves audio content there. That's all I've got today. I hope all you gangsters out there have a fantastic week. And go Braves, everyone. Go Braves. See you guys. I need a